Wall Street considers finally an alternative to stocks. Now, Wall Street says it's done with TINA. For years after 2008 financial crisis, investors held on to the belief that there was no alternative to stocks. Now, bond yields had hit rock bottom. They were even in negative territory in Japan and much of Europe. The stock market, especially in the US, seemed to be the best place to seek robust returns. Then came last year's market sell-off. Stocks slumped and bond yields soared to levels not seen in more than a decade. The moves have made many investors rethink TINA altogether. For the first time in years, things outside of the stock market, including emerging market assets, treasury, and cash, are looking attractive, they say. Fund managers' allocation to stocks is sitting at about 2.2 standard deviation below its long-term average, according to a February survey conducted by Bank of America Corp. Meanwhile, fund managers have more of their portfolios than usual in bonds, emerging market, cash, and commodities, the bank said. Goldman Sachs Group has dubbed the shift TIRA, short for there are reasonable alternatives, while Deutsche Bank's AG has endorsed TAPAs, meaning there are plenty of alternatives. An inside investment has come up with TIRA, or there is a realistic alternative to stocks. Now, after falling 19% in 2022, the S&P 500 has rebounded over 5% this year. The yield on the 10-year U.S. Treasury note is at 3.962% and crossed 4% last week for the first time since November. Money managers who are trying to gauge the market's trajectory say they will be closely watching the Labor Department's monthly employment report on Friday to see whether job growth continued to pick up steam in February. For a number of years, U.S. growth stocks were kind of the only game in town, said David Lefkowitz, head of Equity Americas at UBS Global Wealth Management. Now you can actually get a yield in fixed income. The firm has been advising clients to look beyond U.S. stocks and consider shifting money to areas such as emerging market assets as well as investment-grade bonds. To be sure, bond yields had already climbed to multi-year highs in 2022, and that didn't stop investors from yanking money out of the bond market anyways. Investors took a record $216 billion from taxable bond funds and $119 billion from municipal bond funds last year, according to Morningstar Inc. Major bond indexes suffered their worst declines on record. Moreover, many of the market that investors have identified as alternative to stocks have stumbled recently after rallying to start the year. In February, copper prices posted their budget 1 month decline since July, and the MSCI Emerging Market Index had its worst month since September. Still, many maintain that stocks look less attractive than other assets. Earnings, which investors consider one significant driver of stocks gains, have begun to falter as well. Companies in the S&P 500 are projected to have suffered a 4.6% decline in profit in the fourth quarter of 2022, according to FactSet. That would make their first drop in earnings since the third quarter of 2020. Analysts are also expecting S&P 500 earnings to decline in the first and second quarter of 2023. U.S. stocks still don't look cheap, though. According to FactSet, the S&P 500 is trading at about 17.5 times its next 12 months of expected earnings, above its 10-year average of 17.2. Multiples haven't adjusted to the new reality, said Gautam Khanna, co-head of U.S. multi-sector fixed income at Inside Investment. He has been favoring U.S. investment-grade bonds. It is difficult to justify paying a premium for stocks that carry the risk of losing money when investors can lock in credit market yields ranging from the mid to high single digits, Mr. Khanna added. Stocks in the S&P 500, for instance, offer an average dividend yield of about 1.71% according to Barini Associates. In comparison, a 6-month U.S. Treasury bill offers a yield of 5.129%, up from close to zero at the start of 2022. And major brokerage are offering money market funds with yields above 4%. Some investors also say stocks look more vulnerable than other assets if the economy winds up in a recession. Much of what helped the market bounce off its lows last year was hope that the Fed would be able to tighten monetary policy and contain inflation without pushing the economy into a painful recession. In recent weeks, however, some money managers have begun to worry that instead of slowing down, economic activities might be accelerating again. If that makes inflation stay hot, the Fed might have to raise interest rate more than it otherwise would, potentially increasing the chances of a so-called hard landing. Many analysts believe that stocks likely wouldn't fare well in such a scenario. In a recession going back the last 50 years, short-term bonds, long-term bonds, and even high-yield bonds have delivered better average monthly returns than large-cap U.S. stocks, according to research by Derek Horstmeyer, a professor of finance at George Mason University School of Business. It's difficult to know how well the economy will hold up, but at the moment the risk for investors concentrated in U.S. stocks seem to skew toward the downside, Mr. Lefkowitz said. If there's really a soft landing, maybe U.S. equities can go up 10% over the next year, Mr. Lefkowitz said. But if we do slip into a hard landing, there could easily be 20% downside.